Did you know that you could assume a low-interest VA loan? I'm Sheryl Webb with Weichert Realtors, the web agency.
And I'm Bill McDonald with Van Dyke Mortgage.
Bill's one of my go-to lenders, especially for VA loans. He's really a wealth of knowledge about VA loans, and I'm going to ask him some questions today.
Awesome, let's get to it.
So, Bill, can you assume a VA loan if you're not a veteran?
Actually, you can. You do not have to be a veteran to assume the VA loan. So anyone can assume a VA loan even if they're not a veteran.
So what do you have to do to qualify?
The qualifications are really going to be the same as if you went to a lender like myself. In a situation like this, a mortgage lender or mortgage originator is really not typically going to be part of the process because the loan's already been originated. So you're just getting involved after the fact and you're changing the ownership of the mortgage from person A to person B. And so whenever they go through to qualify it, they're going to qualify it, or they're going to qualify you rather, the same way as if you were buying a home and getting a new VA loan. The credit scores, the debt to income ratio, all those different requirements that come into play for credit worthiness are still going to apply if you're assuming the VA loan. That being said, if you're getting a lower interest rate, you're probably going to qualify a little bit better because your payment's going to be a little bit lower.
What about the VA entitlement? So the person who already has the current loan, what happens to their entitlement if someone assumes their loan?
So you're giving an X amount of entitlement as a veteran, meaning you can buy X amount of dollars worth of house with no down payment. Now that number goes up every year as the Freddie Mac loan limits go up, but that entitlement is reduced every time you use it to buy a home. And so if you used it to buy this home and now you're selling this home on a VA assumption, if you're selling it to a veteran and a veteran who is buying it has enough eligibility themselves and they can just transfer it and release your eligibility, then you're gold and you have all of your eligibility back. There's really no risk to you in that regard. However, if you're selling it to someone who's not a veteran, then your eligibility stays tied up with that home until it's paid off. And so your purchasing power is reduced accordingly, and your eligibility is at risk. If they should ever default, then you've lost the eligibility that was tied up in that home.
So in that sense, then they would be better off with a veteran assuming their loan, but it could be done if everything lines up just correctly for a non-veteran.
Absolutely. There's much less risk selling your home via assumption with a veteran who can use their own entitlement versus keeping your entitlement tied up in that home.
Okay. And so let's talk about some of the advantages of assuming a loan.
Well, most of the advantages, on both sides, really. If you're the seller, like what we're dealing with right now, you may have a 2.5% or 3.5% interest rate, and maybe the market's not real hot where you are. And now one of the great benefits of your home isn't the bonus room as much as it is that 2.5% interest rate.
That's right, because versus going out and getting a new loan at 6%.
Right, you're going to save a lot of money, which is enticing to the people in the marketplace. That rate may be more appealing to them than the house with a newer paint job, whatever the case may wind up being. So from a seller standpoint, the benefit is marketability and appeal to the buyers in that market. From a buyer's perspective, obviously it's the opportunity to get that much lower interest rate. So if I'm out there looking at a home and I see two homes that are pretty similar, you see this all the time, I'm sure, where people are kind of torn between this home and that home. What's the deciding factor? A much lower interest rate could easily be a deciding factor there.
Yes, definitely. Now, if they had bought 4 or 5 years ago when the interest rates were super low, then the housing costs have appreciated a lot right now. What happens if the loan is not enough to cover the new value of the home? So maybe they have a $300,000 loan. Now the house is selling for $400,000. What happens in this scenario?
So the loan amount is going to stay the same. So they're assuming the current loan that's in place now with the principal balance that's remaining on that loan. Well, if you've got all this equity in the home, you want your money. So you're going to have to come up with a down payment. Essentially, I know VA loans don't have down payment. This isn't so much a down payment as almost like a second mortgage. And that may be the answer, where you go get a second mortgage to come behind that first mortgage so that you can give the sellers all the money that they want. Because if they've got $200,000 in equity, they're not wanting to give you that equity, they're wanting their money. So it's either going to come out of your pocket or it's going to come out of the proceeds of a second mortgage that would be filed at the courthouse in a second lien position behind the current VA loan.
How long does this process take? What do people need to expect if they started this process?
I would say 60 days. I've even heard longer. It's really a frustrating process, or can be. Oftentimes, the loan originator is the driving force behind pushing a loan through the process, through the processors, the underwriters, the closers. The entire process is the originator that is constantly doing this, and they're removed from the process. And so I would say if you can identify who originated the loan and ask them to see if they could help. I know if you came to me that you were selling the home from one of the clients that we had sold before, my reputation, my name, my relationship with you would motivate me to get involved and push my team at the corporate level to get this thing through as soon as possible and provide excellent service. So it's really going to depend upon the lender that is doing that. It's not a moneymaker for the lender, so it may not be the highest of priorities unless there's a relationship involved that makes it a priority.
Or maybe you're going to then work with the seller on their next loan.
Absolutely. But again, it is probably, for example, if that happened in our case, the company that is doing the assumption probably wouldn't be my company. And I wouldn't have any influence there. If it was within my company at Van Dyke Mortgage, then I would be on the phone with the people that's involved, and we could get things pushed through quickly and make sure that this stays a priority on people's, in the front of people's minds, so that we can get this taken care of. Like you said, make you happy, and then actually get the transaction for where the sellers are buying their next home.
Okay.
So it is going to be on a lender by lender basis.
What happens with the seller's escrow account if the loan is assumed?
That's going to be closed, and the seller is going to, just like if you were selling your house and you had an escrow account on it, your escrow account is going to be closed, and the buyers are going to set up a new escrow. There's going to be a closing on this.
Yes.
And not to jump ahead, but in terms of closing costs, the lender is limited to what they can charge for this. So you're not going to have the normal lender fees, whatever that they would be. I think it's a $300 admin fee that the lenders can charge. It won't be an appraiser, but the title company that is doing all the work, they still want to get paid. The title insurance is going to have to be paid. The recording tax, the deed tax, all of those fees are going to have to be paid. The year's worth of insurance, setting up the escrow account. So it's going to be a new closing, new escrow account, and then you would have the normal, not quite the normal closing cost, but you're going to have closing costs, a little bit less closing costs, but you'll still have closing costs.
And the VA funding fee, there could still be a VA funding fee of some sort, correct?
Yes, the funding fee is going to be 0.5%.
Okay. Have I missed anything? Is there anything else we need to talk about?
Very interesting opportunity here, and this probably isn't going to come into play too much, but I think that since we're talking about it, it bears a conversation. It bears on the conversation is that I'm actually working on one of these right now where the guy is assuming the loan from him and his wife to put it in his name alone.
Oh, okay.
So they're getting a divorce, and he's wanting to take her off the loan. She's wanting to be taken off the loan. And they were looking at doing a refinance, and they were going to do a refinance, but I said, hold on a second. I think I can save you quite a bit of money, the cost associated with a refinance, by doing this. I did the research, got in touch with the people that I needed to get in touch with, and the answer came back in the affirmative that we could actually do this, which was almost mind-blowing because you're assuming the loan from yourself.
So he's the veteran.
He's the veteran.
And they had the loan jointly?
They had the loan jointly.
And so now he's assuming his own loan to take her off of it. Am I following?
Right. Him as an individual is assuming the loan from them as a couple.
So he doesn't have to start over refinancing the home and lose his interest rate.
Exactly.
Perfect. Okay. What would be the process for someone to start? If someone wanted to start this, can you help them get started? I know you said try to find who originated the loan.
Whoever the servicing company is where you want to start. So if you're obviously this has to start with the people that have the mortgage now. So you're going to get a letter every month from the company that you're making your mortgage payments to, and they're going to be a toll-free number in most cases from the servicing department. You're going to reach out to them and say, hey, I want to begin the process of selling my house via an assumption. And so every company is going to have different personnel or different offices or different people set up for that, but that would be the place to start and let them and be ready to call and call and call. I've got a term that I use, pleasantly persistent. You don't want to be ugly because then your file will fall behind a filing cabinet somewhere, but smile on your face. They'll tell you they have it in a day. That day comes around and it's not there, call back. So it can be done. It happens. As you read online, there's people that deal with frustrations when they're doing this, but they do get through it. For example, we're talking about, if this was us, you would get in touch with me, whether I did the loan or not. if it was with my company, then I can bring my influence into the conversation internally and speed up the process, or at least keep it from being delayed.
Right.
And so as much relationship as you can get involved, find out who the other loan officer was that did the first loan. If you're the seller, if you got a good relationship or still have the connection with the person who closed your loan, that may be a good place to start as well. Probably the better place to start if that same company still has the VA loan.
That makes sense. And I guess one thing that I didn't ask you in the beginning is every VA loan assumable?
Yes.
Okay.
I've never come across a situation where VA loan was not assumable. There is the assumption out there, a lot of times what we begin with this, is that you have to be a veteran to assume it, but you do not have to be a veteran to assume it. You do have to credit qualify with normal credit qualifying requirements, but really I've never come across a situation where a loan wasn't assumable.
Okay. All right. Well, thank you, Bill.
You're welcome.